Welcome to another episode of the Real Estate Market Minute. My mission is to help you better understand the latest trends in the U.S. real estate market and share with you my analysis and industry expertise. I want to help you gain an advantage and feel confident whenever you're buying and selling real estate. I'm your host, Mark Salib. I'm a passionate real estate professional, advisor, and investor, and I love what I do. Follow and DM me on Instagram at The Salib Group. Send me an email, mark@thesalibgroup.com. And as always, thank you for tuning in to today's show. For almost 2 years now, the housing market has been built around one major assumption, and that's that mortgage rates would eventually make their way lower. But now the bond market is definitely pricing in the exact opposite. The 30-year Treasury yield just crossed 5.19%. That's the highest level since 2007, before the great financial crisis. And now you got some folks in Wall Street, many analysts, who are openly starting to discuss the possibility of another Fed rate hike. That's right, I said hike, not cut. Now, the scary part is the market may no longer really understand what's going on here. And I think there's a little bit of, let's just call it, we're not sure what's going to happen, so we're just going to sell and figure it out later. That sort of behavior. And that's very, very emotional type of trading. And that's what the bond market looks like right now. Over the last year, every bullish housing argument was about rates. Just wait for rates to come down. What if they go higher first? And that's what we're starting to see. CNBC, just this morning, with an article, the 30-year Treasury yield just hit its highest level since July 2007 as investors dumped long-term bonds over fears inflation is reigniting. Again, emotional trading. That's what we're seeing in the bond market, and that is extremely concerning. Listen to this quote from the article. This is Jim LeCamp of Morgan Stanley Wealth Management. Quote, "It's a real problem. When we started this year, everybody expected rates to come down. That was part of the bull case. Now it looks like we're going to see a rate hike." Not only that, Ed Yardeni of Yardeni Research, he's warning that the Fed may actually need to raise rates again because inflation pressures may not be fully under control, and the bond market is beginning to reflect that fear. Now, first of all, I just want to say I still don't see rate hikes in the cards right now. I just don't see it. We are definitely transitioning into a dovish Federal Reserve Chairman in Kevin Warsh, who was personally appointed from Mr. President Trump. And to me, that just, the two don't go together. Now, again, his policy shouldn't be dictated by the President of the United States. It could be influenced, though. And, we'll see what happens. But people are going to watch this closely because mortgage rates, as we know, are very, very heavily influenced by the bond market. And the bond market right now looks extremely nervous. When investors sell Treasury bonds at the rate they're selling, yields rise, and mortgage rates will rise with them. So the issue, I'm not as convinced it's about inflation. Now, I know that it is, but I think this recent pressure on the bond market, it's about something else. It's about confidence. And what do I mean by that? I think the bond market is actually asking, will inflation actually come down anytime soon? Are budget deficits just going to keep going higher and higher? Is policy changing too often? And I think they're losing confidence in Washington because it's not really clear as to what's going to happen with this conflict in Iran. And in my opinion, until we get an actual resolution to this debt and inflation situation that we're in, where oil continues to rise at such a rapid rate, why is oil still at $108 a barrel? It's because the market genuinely believes that rates are going to keep going up and oil is going to keep going up. They don't see a resolution right now. They just don't. And I think part of the problem is they don't fully trust the messaging anymore. Every few days the narrative changes, right? You hear all this news coming out. Strait of Hormuz is open, then it's closed, then it's open, then there's some ships coming in, some ships coming out. The war is going to end tomorrow. The war is not going to end tomorrow. The war is going to continue. We have a resolution of the conflict. We don't have a resolution. I mean, it's changing all the time. And the last thing any market wants is confusion, right? They want something clear. They need a clear message, and they're not getting it. And what happens is, and this is what I think is happening, bond investors, they just stop listening. And they just do what they do because they don't know what to price in for this risk. And that's pretty dangerous for the housing market because housing runs on that confidence of monthly payments. Now, I wanted to go back historically because the last time the 30-year Treasury yield was this high, as I mentioned, was 2007. Now, I don't want to say the year 2007 to scare anybody. It doesn't mean there's a housing crash. Lending standards are much tighter today. Homeowners have very good balance sheets. Unemployment rate is low. And folks have a ton of equity in their homes, and they're locked into very low fixed rate mortgage rates. So this is nothing like before. But the similarity lies in long-term borrowing costs, right? Affordability, buyers, extremely payment sensitive. We have an affordability issue. And when you have economic uncertainty rising like you do right now, that does cause some instability. Now, if you go back to the early 80s, the early 1980s, Treasury yields exploded higher then too. Mortgage rates went into the teens, and housing activity went on to completely freeze. Now, I'm not predicting that, but it does show you just how quickly housing slows when lending and financing costs rise too far too fast. We saw it. We saw it recently in 2021. All right. Where could they go? All right, if I look at this historically, I got mortgage rates following the 10-year Treasury yield, which we just noted has been rising rapidly and is the highest since 2007. And mortgage rates typically are about 2 to 2.5% above where the 10-year Treasury yield sits. So if the 10-year Treasury is right around 4.6% right now, you would probably venture to see mortgage rates anywhere from that 6.5% to 7% for the 30-year fixed. Now, if inflation gets worse and the 10-year keeps moving towards 5%, well, I mean, it's realistic to say mortgage rates could end up above 7%, even as high as 7.5%, which we had seen just a few years ago. Now, remember, psychologically, that's a big difference between seeing a 6 handle and a 7 handle on mortgage rates. So buyer demand, once again, dramatically changes. And that is the last thing we need as they were starting to come back, especially entering the spring, summer seasons. Okay. Now, the other issue, and if you listen to the episode right before this one, I talk about home builders and kind of where their sentiment is at in the latest sentiment index that came out. If rates stay elevated, we know buyers can't afford payments, and we know home builders have to keep offering incentives. We see that in the last report. Their margins just simply compress, and their confidence will weaken even more. So I would expect that to get much worse than even what I talked about in the last episode, which wasn't great. All right, so builder sentiment needs to be good, folks, because you want builders to build homes. Remember, we are still facing a shortage in homes. So home builders need to be confident. All right, over the last year, the entire housing market has basically been waiting for lower rates. But the bond market is telling us something very different. This headline is a bit scary. Now, I have been saying, and I have been essentially, as I mentioned on Monday's show, go back and listen to Monday's show, I'm sounding the alarm on interest rates and affordability. I'm sounding the alarm. And I said that because, and here we are, here we are. The bond market is reacting. The market doesn't seem to care about these so-called optimistic headlines coming out of Washington anymore. It wants more credibility. And until investors actually believe inflation is defeated and oil will calm down, and this conflict is actually over, mortgage rates are going to remain much, much higher than people expected. That is it for me today. Thank you so much for listening to today's show. And as always, if you have questions or need specific advice, ideas, or just some help regarding your particular real estate needs or situation, or if you're just looking to buy or sell real estate in Florida, well then DM me on Instagram at The Salib Group, or just send me an email to mark@thesalibgroup.com. Don't forget to leave a rating for the show, follow, subscribe, help others find the show, and be informed and educated about the real estate market just like you. Until next time. Before we end today's show, stop what you're doing and subscribe right now to Real Estate Market Minute Plus. Listen to all episodes ad-free. Get exclusive bonus episodes and content, and help support the show's growth, longevity, and future improvements. Go to realestatemarketminute.supercast.com right now. You can also find the link in this episode's show description. Check it out. I know you'll love it.